U.S. stock market is officially open for trade. Joining me now is Satyam Pandey, Chief U.S. and Canada Economist at S&P Global Ratings. Welcome to the show.
Thanks for having me.
So what will you be monitoring most closely during today's session?
Well, we don't have much of the government-based data coming out, so we are sort of running in a little bit blind. But at the end of the day, there will be the Fed's minutes to the meeting that just happened in September. I think we'll be monitoring that closely to see exactly, how the discussions went, whether the Fed will be sort of in a more of an easing mode, or is it not really as automatic as the markets are pricing in right now?
All right, and how much could the ongoing government shutdown, in your opinion, impact GDP growth, and why?
Well, the government shutdown, it really depends how long it goes. The longer it goes, it has a non-linear impact and a negative impact on GDP growth. But in general, in the past, we've seen about 0.1 percentage points shaved off quarterly annualized growth for every week shutdown. But in the long run, it's basically all the productivity lost during the shutdown that's never really recaptured. And that is more. So overall, still minimal, but it does start to add up.
Do you think this shutdown differs from prior shutdowns when it comes to the economy?
Well, there's one aspect of it, right, so that it really is different. We were already, the policy coming out of the Trump administration was already thinking of having more layoffs in the federal government. So given the shutdown and some of the temporary layoffs in place, it seems like some of those temporary could turn into permanent layoffs. So that would be adding more to the labor market weakness, at least from the federal government side of things. Besides that, the data that had been coming out were already showing some mixed messages. And given that, now we don't even have the data in hand to look for, it becomes a little bit more murkier exactly where we are headed. And the Federal Reserve, which is quite data dependent right now, has to sort of, fly a bit blind because data is not available.
And we didn't, as you've mentioned, receive the September jobs report due to the shutdown. How much does this complicate the Fed's monetary policy decision making?
Well, it really depends how long it goes on for, but given what we have so far, if it were to, let's say, last another week or two, we won't have the data for September, both inflation and employment. So that does create a bit of a issue for them. I think at this point, they have basically seen the summer numbers come in, and they are ready to perhaps give another 25 basis point rate cut. For the time being, they're more concerned about the employment weakness, the risk around that, than the inflation side of things. But after the October FOMC meeting, that's when things really start to get.
And the latest Fed minutes are coming out tomorrow afternoon. What are you going to be looking for?
Just what the discussion around inflation looked like, whether folks think this is just a temporary one-time tariff-related inflationary impulse, or are we thinking of more persistent, even service-based inflation that they may want to kind of hold off on some of the easing bias that they've been showing in their recent speeches.
All right, and over 90% of traders are pricing in a rate cut later this month. That's according to the latest data. And given the recent uncertainty, how many cuts do you foresee for the rest of 2025 and into 2026?
So we have assumed about 100 basis point rate cuts from here on through next year. So basically, 2 more 25 basis point rate cuts for this year, and then another 50 basis point through next year. That is with, that is with our view that inflation is going to be around 3%. So the Fed is not going to be cutting fast. It's going to be a gradual rate cut, but it is going to be on the rate cut side than on the increasing side for now.
All right. Thank you, Satyam Pandey, Chief U.S. and Canada Economist at S&P Global Ratings.
Thanks, man.